Well, we make bad investment decisions plenty of times. I make more than Charlie because I like to think it's because I make more decisions, but probably my batting average is worse. But I can't recall any time in the history of Berkshire that we made an emotional decision. That I know the movie had Jamie Lee in there, but that was for laughs. But have we ever made an emotional decision?
No.
No. That's in business we're talking about.
Have you ever watched the stock market leap up one day, then plunge down the next, and felt your heart racing along with it? You're not alone. Investing can feel like a roller coaster ride, and it's all too easy to let our emotions take the wheel. But what if there was a better way? What if you could invest confidently, calmly, and consistently, no matter what the market is doing? Welcome to our video guide on disciplined investing, where we'll show you how to take control of your financial future by mastering your emotions. This isn't just about making more money, it's about achieving peace of mind and securing your financial well-being. In this video, we're going to cover key strategies for disciplined investing, including how to set clear goals, create a diversified portfolio, and stick to your plan even when the market gets rough. Now, let's talk about Jack, a businessman who started his own restaurant. Jack did extensive market research, picked an excellent location, and developed a unique menu. However, he didn't consider the importance of marketing. Despite having a great concept and delicious food, Jack's restaurant struggled to attract customers due to lack of visibility. Eventually, he had to close down his business. Contrast this with Rachel, who also decided to open a restaurant. Like Jack, Rachel did her homework on the market and location, but she also understood the power of marketing. She hired a PR agency to generate buzz before the launch and invested in social media advertising to reach a wider audience. Rachel's restaurant was a hit from day one and continues to thrive. These examples illustrate the importance of planning, strategy, and patience in investing in business. Jack suffered losses because he ignored crucial aspects, like the importance of marketing. On the other hand, Rachel succeeded by having a clear strategy and sticking to it, demonstrating the value of discipline and long-term thinking. Whether you're investing or starting a business, these stories underline the need for a well-thought-out plan, a calm approach to challenges, and a willingness to learn and adapt. Both investing and running a business are long-term endeavors that require patience, resilience, and strategic thinking. Investing is not a get-rich-quick scheme. It requires patience, discipline, and a well-thought-out plan. Here's a detailed look at some strategies for disciplined investing. Investing can seem like a complex and daunting task, especially for beginners. However, the key to successful investing lies in education and understanding.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor?
Familiarize yourself with the basics of investing, such as the principles of risk and reward, diversification, and compounding. You need to understand how different types of investments work. These include stocks, which represent ownership in a company, bonds, which are essentially loans to a government or corporation, mutual funds, which pool money from multiple investors to invest in a diverse portfolio of stocks, bonds, or other assets.
Well, if you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case.
And real estate, which involves buying property as an investment. Each type of investment carries its own set of risks and rewards. Stocks, for example, can offer high returns but also come with high risk. Bonds are generally safer but offer lower returns. Mutual funds offer diversification, which can reduce risk, while real estate can provide steady income through rent, along with potential appreciation in value. By understanding these nuances, you can make informed decisions about where to put your money. There's a wealth of information available to help you learn about investing. Online resources such as websites, blogs, and podcasts offer valuable insights. Books on investing can provide in-depth knowledge. It's important to continuously educate yourself as the world of investing is dynamic and constantly evolving. Investing is not a one-time activity, it's an ongoing process that requires regular attention. Over time, various factors can change your financial needs and goals. Changes in your income, family situation, like the birth of a child or a spouse retiring, or retirement plans can all impact your investment strategy. As such, it's crucial to regularly review your portfolio to ensure it aligns with your current objectives. This isn't just about checking your portfolio's performance, it's also about evaluating whether your investments still match your goals, risk tolerance, and time horizon. This review may lead you to rebalance your portfolio. Rebalancing involves adjusting the proportions of different types of investments in your portfolio. This is done to maintain your desired level of risk and return. For instance, if some of your investments have performed exceptionally well, they might now represent a larger portion of your portfolio and expose you to more risk than you're comfortable with. In such a case, you might sell some of these investments and invest more in others to bring your portfolio back into balance. Investing is a marathon, not a sprint. Many people are tempted to time the market, aiming to buy low and sell high in quick succession. However, this strategy is not only difficult, but also risky, as no one can predict market movements accurately at the time. Instead, a disciplined investor focuses on long-term growth. Long-term investing means buying shares in companies or assets that you believe have solid growth potential over the years. This approach requires thorough research into the company's financial health, business model, competitive advantage, and industry trends. It's not about jumping on the latest hot stock, but about finding companies that will thrive in the long run. Moreover, long-term investing allows you to take advantage of compounding, which Albert Einstein famously called the eighth wonder of the world. Compounding is the process by which an investment's earnings from either capital gains or interest are reinvested to generate additional earnings over time.
The biggest thing in making money is time, and I've had this long run, and so the compounding at the end turns into very big numbers. But you've got a tailwind in this country if you just own a cross-section.
This snowball effect can significantly boost your investment returns in the long run. In addition, long-term investing can be less stressful than short-term trading. You're not constantly watching the market and worrying about daily price fluctuations. Instead, you're giving your investments time to grow and weather the ups and downs of the market. Investing can stir up strong emotions. When markets are rising, it's easy to get swept up in the euphoria and make impulsive investment decisions. Conversely, when markets are failing, fear can lead to panic selling. However, making investment decisions based on emotions often leads to poor results. For instance, investors who panic and sell during a market downturn may lock in losses and miss out on the potential recovery. On the other hand, investors who get carried away during a bull market may end up buying at peak prices and suffer losses when the market corrects. It's important to stay calm and stick to your investment plan even when the market is volatile.
You don't need a lot of brains in this business. I mean, I've always said if you got an IQ of 160, give away 30 points to somebody else because you don't need it in investments. What you do need is emotional stability. You have to be able to think independently, and you have to be...
Your investment plan should be based on your financial goals, risk tolerance, and investment horizon, not on emotions or short-term market movements. Dollar cost averaging is a strategy that can help mitigate the impact of market volatility and reduce the risk of making a large investment at the wrong time. It involves investing a fixed amount of money at regular intervals regardless of the price of the investment. This strategy ensures that you buy more shares when prices are low and fewer shares when prices are high, which can lower the average cost per share over time. It also takes the emotion out of investing, as you're not trying to time the market. Moreover, dollar cost averaging can be an easier and more manageable way to invest, especially for beginners or those with limited funds. Instead of trying to save up a large sum to invest all at once, you can start investing with small amounts regularly. Investing with discipline is not about eliminating emotions, that's impossible. It's about acknowledging our feelings without letting them dictate our actions. By setting clear goals, diversifying our investments, and sticking to our plans, we can navigate the ups and downs of the market with confidence and poise. Remember, the road to financial success is a marathon, not a sprint. It takes patience, consistency, and yes, discipline. But the rewards, financial security, peace of mind, and the freedom to live life on your terms are well worth the effort. We hope this video has given you valuable insights into disciplined investing. We'd love to hear your thoughts, experiences, or any questions you may have. So, don't forget to leave a comment below and subscribe so we can continue the conversation and learn from each other as we journey towards financial well-being.